Good day, everyone. Today, we present the case of Encore Incorporation, a company that turned an old investment into a surprising year-end profit through a sale involving a zero-interest bearing note. We are Group 1. And I am Dali Fatima. I am Bukatot Francie Irogin. I am Espinosa and Maria. I am Pulido Nicole. I am C. Jude Apple. And we are Group 1. And we will be tackling accounting for zero-interest bearing note. We will show you the case that was given by our professor. Now, since this is a long problem, we will summarize it by a case overview or background. Encore Incorporation, nearing the close of its fiscal year on December 31, 2025, recently sold a long-held investment, which is shares in Heaven Enterprises, for 20 million pesos to Axel Limited. Now, this investment originally cost 12 million pesos and has not generated any returns since acquisition. This sale is notable because payment will be made using a zero-interest bearing note, with annual payments of 2 million pesos over 10 long years, starting December 31, 2025. The market rate for similar financial instruments is 8%, which will be used by this case. The controller has recognized an 8 million peso gain and suggested that it will significantly boost the company's income for the year. Now let us tackle the key issues and the problem statement for this case. We have three genres for this case. First is the accounting issue. The key accounting issue lies in whether it is appropriate for Encore Incorporation to recognize the full 20 million pesos amount from the sale of shares and record an immediate 8 million peso gain, even though the consideration is in the form of a zero interest bearing note. Next is ethical concern. Now, in the case that I read earlier, there is a clear risk of earnings management. Management appears to be overstating income in order to justify year-end bonuses and present an unusually positive performance in an otherwise declining industry. This undermines the principle of faithful representation and misleads investors as stakeholders who rely on financial reports and decision making rather. Next is regulatory compliance. Now, under PFRS 9, financial instruments aligned with IFRS 9, financial assets must be initially measured at fair value, and interest income must be recognized over time using the effective interest method. Now, similarly, under the US GAAP, companies must impute interest or use implied interest when a note has no stated interest or an interest rate below market.
So now let's move on to the analysis of the case. The relevant accounting standard for this case, the PFRS 9 financial instrument. First is the initial recognition and measurement. According to PFRS 9, a financial asset such as a note receivable shall be recognized when the entity becomes a party to the contractual provisions of the instrument. It also states that financial assets are initially measured at fair value, plus or minus in the case of financial assets not at fair value through profit or loss, transaction cost. Second is the determining the fair value or the present value of the future cash flows. PFRS 9, if a financial instrument like a note is not traded in an active market, its fair value must be determined using valuation techniques such as discounting future cash flows using a market rate of interest. In this scenario, the note pays 2 million annually for 10 years but bears no stated interest. The market rate for similar instrument is 8%, so the present value must be calculated using that rate. Next is the amortization of discount using effective interest method. Under PFRS 9, after initial recognition, financial assets are measured at amortized cost using the effective interest method, provided they meet the criteria for classification under this category. The effective interest method spreads the discount, the difference between the face value and the present value, over the term of the note. This process results in interest income being recognized annually and the carrying amount of the note increasing until it equals the face value at maturity. And last is the revenue recognition or gain on sale. While PFRS 15, revenue from contracts with customers, generally governs revenue from ordinary operations, this case involves the sale of an investment. Therefore, the gain should be treated under PFRS 9 as a disposal of a financial asset. So the gain on disposal must be calculated based on the proceeds received, which is fair value divided by the PV of the note less the carrying amount of the asset sold. Thus, Incorporated should only recognize a gain of 1,420,200 pesos, not 8 million. Now I will be presenting the Google Sheet for accounting for zero interest bearing note. With a selling price of $20 million, the cost of investment of $12 million, a term of 10 years, an annual payment of $2 million, a market interest rate of 8%, and the first payment date on December 31, 2025. The present value of the note is calculated using PV of ordinary annuity, since the installments are done equally at the end of each reporting period. Using this, we got 6.7101, and the annual payment of $2 million, resulting in the PV of 13,420,163. The discount of the note is calculated using the face value of $20 million, the present value that we calculated earlier of 13,420,163, which results in an unearned interest income of 6,579,837, which will be amortized over the course of 10 years. Here is the amortization table, which shows columns including the date, payment, interest income, unearned interest, and carrying amount, beginning with December 1, 2025, which is the initial recognition of this note. On December 1, 2025, it has the unearned interest of 6,579,837, a carrying amount of 13,420,163. So December 31, 2025 is the first payment of the installment, and the interest income is calculated by multiplying the carrying amount with the market interest rate of 8%, which is then subtracted to result in the unearned interest which is subtracted to the carrying amount, resulting in 12,493,776, and this goes on until December 31, 2034. We also calculated on the gain on sale of investment using the present value of the note subtracted to the book value of the investment of $12 million, which resulted in a gain of 1,420,163. For our journal entries, they are mostly the same, except for, of course, the initial recognition and the final journal entry. December 1, 2025, we recognize a debit of notes receivable $20 million and credit of investment in shares in Heaven Enterprises of $12 million, unearned interest income of 6,579,837, and a gain on sale of investment, which we calculated earlier, of 1,420,163. For the first payment of December 31, 2025, we recognize a debit in unearned interest income of 89,468 and the same credit interest income. Cash is debited for 2 million and notes receivable also credited for 2 million. And we calculated the carrying amount of the note for this year by using the notes receivable of 18 million subtracted by unearned interest income of 5,506,224, which results in a carrying amount of 12,493,776. So this goes on similarly. And then we end in December 31, 2034, an unearned interest income of 148,148, credit interest income the same amount, a debit in cash of 2 million, credit in notes receivable 2 million, and a notes receivable 2 million less unearned interest income 0, annual payment of 2 million, which results in a carrying amount of 0.
These are the assumptions of the problem. First, AXA Limited will fulfill all future payments on time. The present value calculation and the revenue recognition rely on the assumption that AXA Limited will not default on any of the annual 2 million payments. This implies zero credit risk, which may not reflect reality, especially for a company described as tight for cash. Number 2, the 8% is the appropriate market rate for the note with similar risk and term. Number 3, no transaction costs were incurred. Under PFRS 9, transaction costs directly attributable to the acquisition or issuance of a financial asset must be considered. Assuming zero cost simplifies the calculation but may exclude material adjustments to the initial measurement of the note. Number 4, the investment in shares was classified as a financial asset under PFRS 9. It is assumed that the original 12 million investment was classified as a financial asset at fair value through profit or loss or through other comprehensive income. This impacts whether the gain on disposal is recognized in profit or loss or in other comprehensive income. Next are the limitations. Number 1, there is no credit risk or impairment analysis was provided. It is required by PFRS 9 for long-term receivables. Number 2, there is no consideration of tax effects. Example is the deferred tax on gain. Number 3, inflation, currency effects, or changes in market rates are ignored. I'm going to discuss the missing information of the problems. First is the classification of the note receivable. Under PFRS 9, financial assets must be classified based on the business model and the SPPI test, which is solely payments of principal and interest. It's unclear whether the note meets SPPI criteria or how NCOR intends to manage it. Number 2, board-approved bonus plan metrics and criteria. Without visibility into the bonus plan, it's difficult to evaluate whether there's a conflict of interest or manipulation incentive in recognizing the gain prematurely. Number 3, audit committee or board oversight in revenue recognition. There's no mention is made of oversight controls in the approval of revenue recognition or financial reporting policies. This omission raises concerns about governance and whether proper review procedures were followed.
For recommendations, first is to restate the financial statements and adopt effective interest method. First, NCOR must restate its 2025 financials to reduce the reported gain from 8 million pesos to 1.42 million pesos and record the note at present value with 6.58 million pesos as unearned interest. This complies with PFRS 9 and stops profit in overstatement. Second is to use the effective interest method to recognize income fairly. Year 1.07 million pesos interest adjust annually as payments reduce the note's carrying amount. This matches revenue with the time value of money. No more front-loading gains. Second is to disclose all details in the financial statements. Note terms, maturity, and payments, 8% market rate used for PB calculation, and policy for unearned interest recognition. Transparency builds trust with investors and auditors. Third, ethical and managerial action. Finally is to revisit bonus policies. The bonuses to long-term performance, not short-term profit spikes. Train staff on PFRS 9 and revenue recognition. Consult auditors early for complex transactions. This prevents future creative accounting risks. By following these steps, NCOR can correct its books, comply with PFRS, and restore credibility. Remember, accurate accounting isn't just about rules, it's about integrity. To conclude, fair value, not face value, must be used when recognizing zero interest-bearing notes in line with PFRS 9 requirements. Recording the full 20 million pesos as immediate income overstates both revenue and assets. The correct approach is to recognize the present value and amortize the discount using the effective interest method. Ethical concerns arise due to the potential for earnings manipulation aimed at inflating performance and triggering executive bonuses. The current accounting treatment violates standard financial reporting principles, misleads stakeholders, and undermines faithful representation. Proper application of standards ensures transparency, comparability, and integrity in financial reporting. The correct application of PFRS 9 requires NCOR Incorporated to recognize the zero interest-bearing note at its present value, not the face amount. The gain on sale should be limited to the excess of the PV of proceeds over the investment's carrying amount. Failing to follow this treatment materially misstates income and may result in misleading financial reporting and unethical outcomes, such as undeserved bonuses and manipulated performance metrics. Thank you for watching. Thank you for watching. See you in IA2, ma'am.
Bye.